I personally would not be able to own the portfolio that I have without the ability to raise capital. There's just a limit to how much money I have personally earned and saved to be able to build my real estate portfolio. Like the main benefit of real estate investing is leverage. And I really break that down in detail in the Financial Freedom series. Even in Wealth Through Real Estate, I break that down into detail. I give you guys access to that, the Financial Freedom Blueprint, various ways for you to achieve financial freedom, pros and cons of the different real estate assets. If you don't have that link, go to my Instagram at Michael MNAT. There's a link in my bio that literally gives you access to a lot of this stuff for free. So we're going to leverage today is super deal analysis. I will be analyzing this deal with you and seeing if there's opportunity to renegotiate it. This deal came from a wholesaler. I'll show you from the Super Deals database, basically a platform, a portal where wholesalers and dispo guys can drop some deals in here for people to analyze and buy. So we'll look through here and find us the right property to analyze real quickly. Just basically a database of creative deals for you to look at. I've got some filters in here. I'll explain all that, what types of properties I'm looking for. We will analyze the deal. So I will leverage the new version of the Super Investor Real Estate Calculator. I do provide a free version of this, and everything, both the free and my old paid version, are getting massive upgrades because I've gone and made this an all-in-one calculator now. Basically, whether you're doing hybrid, subject to, seller finance, traditional deals, all of it can be done on here. Very straightforward. So whether you're buying deals cash, traditional, or with a DSCR loan, creatively financed, like leveraging hybrid, subject to, seller finance, all of that can be done on this one calculator. And even more importantly, once you understand the debt of the property, the acquisition into it, and your entry costs, you can then analyze long-term rent, co-living or pad split, midterm, short-term, and then you select what management strategy do you want. So you get analysis per each strategy. Select the management strategy that you want. And this will tell you, this will also tell you what is the highest and best use strategy. If you analyze all these various ways, this will quite literally tell you which of these strategies is the best one between co-living, long-term, midterm, and short-term rental. And then what the analysis looks like over a long enough period of time. So like this is 20 years, right? So snapshot at 5, 10, and 20, as well as some ability to renegotiate this deal, but that is only possible depending on the acquisition strategy. Then we'll get into the capital raising. This is literally the cheat code. This calculator, it's one thing, plenty of people have calculators to analyze deals. Most of them suck, and I know that because I've used a lot, and also because mine ranks almost immediately as one of the top creative finance real estate investment calculators that are out there, which is awesome. I don't say that. I say that just because I know it's a valuable resource, and that is the data that I have, is that the majority of people are using this, and they're searching this, and they're leveraging this because they prefer it. So with that being said, the main reason why I love this calculator is not just the analysis. Lots of places have good enough deal analysis calculators. The real value is this using other people's money tab. You can quite literally see virtually instantly, if you had a private money lender and the loan amount was your entry cost, would this probably be profitable? How much would you cash flow if you were paying a private money lender, right? Or if you go the private money partner route, all you do is you select a percentage. I'm going to give them 50% cash flow, 50% ownership. What would the returns look like for them? Well, how much cash flow would they get? How much debt pay down benefits do they get? How much appreciation do they get? How much tax benefits do they get through interest payments and depreciation? In addition to the cash flow, what are their total returns? So then what is their cash on cash? What is their return on investment? All this is done automatically once you analyze the deal and you select what percentage do you want to provide your partners. All that's automatically done. I think I said this as cash. That's why it's so wonky. That's why it's such a huge capital raise. Yeah, that's why cash sucks. Deals don't really make a lot of sense cash unless you're just storing money. We'll analyze this deal. And then there's the analysis over the long term, right? What does this look like over the next 30 years? Some of the properties you're buying are subject to, and maybe there's only 25 years left on a loan. What happens after 25 years and that loan's paid off? What do your returns look like? It's good to see that, the full picture. If you're raising money through a private money lender, hey, you have something you could very simply screenshot and snapshot over to them, the returns. But if you have your private money partners, this is literally what I put in. This is literally what I screenshot and share to my capital partners. Say, hey, these are the returns for the deal. This is your returns for this investment. I say, here's the returns, screenshot it. It's a little easier to see once it's closer. And then this is the analysis for you. This is your 5-year return, your 1-year, 5-year, and 10-year returns. And a lot of my partners are 5-year holds. This is the cheat code. This makes your life so much easier when you have tools like this to help you be able to not only analyze, but also raise capital pretty seamlessly. As someone who analyzes a ton of deals and raises capital for tons of deals, this is exactly how it's done. All right. So with all that being said, if you want a copy of the free version of this, I have my old version still out there. You go to the free Wealth Through Real Estate School community, or you go to my Instagram. You go to my link tree, click on that, my buy box and free tools. Click that. And here it's got a brief summary. You literally put in your email here and you'll get the current version of the free creative finance calculator that I created. And by the end of May, you're going to get a new link to the new free version. It's not going to be as thorough as this one because this is the super investor one. This is the paid one that super investors get, or people can pay for it separately. Although I think it makes more sense to do it collectively through super investors. It's your call. If you do this, you'll still get the whole analysis page. You just won't get all the capital raising long-term analysis. You will get access to this one, the current one immediately, the free school community where you can figure out your financial freedom and all that good stuff. And you also get the new version of it when it comes out at the end of this month. And then you'll see my buy box. You'll see all these things. So with all that being said, let's analyze some deals. We're going to look up a property. I don't even care what property it is. I want you guys to go through the mechanics of analyzing a deal more than I care about the actual deal working out or anything like that right now. I'm not looking to buy a deal this second. Well, I guess if it's a good deal, we'll buy it. I mean, that's always the case. But so let's see. Let's go to the Pad Split website. So I'm already on the Pad Split website. I wanted just for you to get a general idea of the different markets that Pad Split operates in. This is essential. That's also when you sign up, literally use this free link right here. If you're on Instagram, I always recommend that you go to YouTube. It's way better and way more interactive. So you can get all this data that I'm about to show you for free through Pad Split. You can literally see all the different markets Pad Split operates in. Blue is a core market. This is a market they're already established in and have rental properties. This gray is emerging. So these are markets that they are now going to be working more in. They don't have properties there yet. They'll probably have them in the pipeline, right? But they're not operational yet. I primarily only focus on core markets, the majority being in the Southeast. So North Carolina, Georgia for sure, and Florida, as well as some properties in Texas. This is my main area. People that are in super investors, that are just co-living people that I know, they invest all over the place. You can invest all over the place. I own properties in a ton more states, but I don't operate them as co-living because I bought them for different reasons. They may not make the most sense as co-living. So with all that being said, let's go and search and see if we can find a great property. So we have, let's do Arizona. We can do Nevada for Las Vegas. I already have Florida, Georgia, North Carolina, excellent. Let's do, so nothing in Nevada, NV. And we got Texas. It looks like there's 2 on there, but that's okay. So we're gonna apply that real fast. What we're gonna next do, and then we'll later search it in here. I have some other filters, right? So this is why it's so important that you look at you can literally cheat. You can copy my buy box to recreate your own. My buy box is much bigger than most because it's not just me. I also have 60 other super investors always looking for great co-living deals. So there might be markets that they're willing to buy and that I'm not, that I will then help connect these deals to people. So if you're a wholesaler or a bird dog, I can help connect you to these super investors so that they can buy your deals. But in general, we're looking for co-living rentals, 3-bed, 2-bath minimum, 1,500 square foot minimum. Creative finance is the only way we're buying deals right now. And there's some preferred items, right? Like ideally lower interest rates, ideally lower entries. It's not that, but it's a great deal. That's fine. That's awesome. Ideally, not a ton of renovations. You don't really want to combine a lot of renovations with creative financing because then you're going to have a lot of money stuck in the deal. I won't get into the weeds of that right now, but basically you buy deals at a discount, primarily through cash, right? Whether it's a hard money loan or your own funds, private money lenders, whatever. You buy it cash, renovate it, and then sell it or refinance it. When you're buying something creatively, you don't want to put a bunch of money into it because if you were to sell the property, well, who cared that you bought it creatively? And if you were to refinance it, we just lost that great debt. So the only way to get your money back out through a creative deal is to sell or refinance the great debt, which is the reason why you bought that property in the first place. So it doesn't really make a lot of sense to go that route. There are some creative opportunities like a Morby method where you combine seller financing and new debt, whatever. That's like a way, but that's a whole other thing. All right, so you can see my buy box right here. Like I said, it's in my Instagram. If you want to just partner with me, you don't want to do any of this crap. You want solid returns on your money or you want actual ownership on deals, you can do that by becoming my capital partner. Very simple form. You want to learn about super investors or the free wealth real estate community, that's on here as well, just as an FYI. But here's the buy box. You can copy this for yourself. Just choose your own markets, right? You may not have the ability to do as many markets as I do, but then in here, the submission form, it also has the core Pad Split markets as well. So you can see some of their core markets right here, but it's also on the Pad Split site, which I shared you. And then if you sign up literally for free on Pad Split using the link I provided you, you will get tools just like this one to then be able to see data on these properties. So with that being said, let's look at some properties and filter based on the buy box I provided. So I did put interest rate just 6% or lower. I put no HOAs. I'm not a fan of HOAs. Some people are cool with them. I'm not putting anything for, well, we could put, 3, 4, 5 or more beds, 2, 3, 4, 5 or more bath. I don't care that comes furnished. I put hybrid, seller financial subject to square footage. So over 1,500 square feet. Port Charlotte's okay. There's not gonna be a ton of data. Carrollton, I looked this up. It's too far away from from Atlanta for it to make sense for me. There's not going to be a lot of data. Well, we can look and see what you can, when you go side by side, you can see maybe there is data there. So we click Atlanta. Oh, actually, you know what? There are units here. It's further than what I personally like. 23 active units. You know what? We can use this data. Even though it's a small sample size, we can use this data. So potentially that is the deal that we will analyze. So we'll come back to that one. We like that one. Let's avoid Florida if we can. No. I liked this one. This one was outside of Houston. I saw this one, but this one does have an HOA. So it says no HOA, but I thought I saw this one did have an HOA. I think this is the property. So guys, remember, I'm already looking at deals like this all the time. Oh, this might be a different one. Okay, so this one could be interesting. Really big house, no HOA. So we like this Mesquite, Texas one. So there's two that I'm looking at now. And honestly, you could go and buy these deals right now for all I care too. I've looked at this one before. It's more renovation than I would like to do on a creative deal. Seems like too small of markets. Jacksonville's a solid place. We could always look at this one. 3-bed, 2-bath. But if you guys want to drop one of the three, we can do one of those, and there's more. So Jacksonville, Florida is a subject to, so there's not a lot of renegotiation there. If it's hybrid or seller finance, I can show you guys how to renegotiate as well based on the numbers. We have Mesquite, which is subject to as well. What was this last one? Subject to as well. Is that the lowest interest rate? We have it up right here. I don't see any consensus one way or another. So let's go with this Carlton one. So we're already here. We're going to go to the calculator, and the first thing you do, because you already made a copy. So the first thing you do, you only get a copy to this calculator. You make a copy. So what we're going to do is we're going to put the property information first. We're going to take this. We're going to double click into the cell, copy paste. This is a 3-bed, 3-bath, 1689 square feet. So this may not have a ton of bedrooms, so this may not work. We're going to do the entry cost next. Let's go into the debt information. So if we look at this property, it's a straight subject to deal, so no seller finance, right? So we're going to select this as subject to. Purchase price says 290,163. 290,163. I get this question asked to me all the time because we like to break down cash to seller, cash to wholesaler, cash to agent. That's why in our entry cost right here, it literally asks, you got your down payment to the seller. There might be some arrears or liens, some loan payment that needs to get caught up. It doesn't really say that anywhere, but that could be the case. Or you're paying back part of their mortgage that they didn't. We can look that up on PropStream and see. We'll get some info there. Agent commissions. So really we're looking to see down payment to seller, arrears or liens, agent commissions, and wholesaler assignment fee. This entry cost of $40,700 is. What's confusing to me here is the mortgage balance is $212,000. The entry fee is $40,000. So those two combined is $252,000. What's the other $40,000 in the purchase price? You would think that would be seller finance equity. That's how it should be. So I don't understand why there's a discrepancy between the two. Because that's the case on this one, we're going to have to do a lot of guessing. Let's not even waste our time. This is one of those you ask the wholesaler, hey, so this is something to understand. The mortgage balance plus the cash plus the entry fee, that purchase price should not exceed that, because the purchase price in essence it's one of two things. It's either the debts that you're taking over plus the entry costs into the deal, not the closing costs and TC costs, but the money to the wholesaler, the money to the agents, the money to arrears, the money to the seller. Right? Or what I prefer is that all those are separated. I prefer when the arrears, acquisition fee, or the wholesaler assignment fee, the arrears and agent commissions are separated from that. And my purchase price is actually the down payment cash to seller plus the debts that I'm taking over, subject to or the new seller finance debt, right? That is the route I prefer, and I separate the other ones as entry fees. That's not always the case. It depends on how the wholesaler put it. But when the entry fee plus the mortgage amount is less than this purchase price, there's something that's missing. I would assume the rest is seller finance. However, that's not really articulated anywhere here. It doesn't say that that's the case. Maybe there's a seller finance with a balloon payment in the future. I don't know, right? This is not my deals. I'm presenting you guys deals to be able to look at, analyze, buy, whatever in a consolidated way. This, I would assume either the purchase price is wrong, which could be the case that we don't see here. Because we don't see that, it's going to be really hard to analyze this one. So with that being said, we're going to go to 32211 in Jacksonville. All right. Sometimes it gets weird when you already do one. Great. So I've actually looked at a property here. We almost bought a property right there. 107 active units. It's got great data. So 107 active units, 181 per week shared bathroom, 261 per week private bathroom, 92% average occupancy. So on average, there's only an 8% vacancy, right? 100% occupancy is the goal. It means your property is always full all the time. It's not realistic, but that's the goal. That minus the vacancy is your average occupancy, or your 100% minus your average occupancy is your vacancy. So when you're analyzing and you're wondering what your vacancy is, that's the percent. 4 days to first booking, which is great. You put a property up, you get people in there within days. And then by the end of the month, you could expect around 80% of your property booked out. All right, good data. You can look at the whole market of Jacksonville and see that, okay, 1,673 active units, almost 11,000 have searched in the last 30 days. So you have a lot more demand than there are active units. Excellent. You want more people looking than there are units available. And there's not a ton coming up. So that's great. It's not like this thing is going to have, they're going to double this co-living rentals in this market immediately. So that's great. You have the data for the whole area of Jacksonville. Just show you the occupancy, that stuff that I was talking about. So you see it right here. If you're not using pad split, you're literally, even just for the sake of deal analysis, you're literally trying to do co-living with your hands tied behind your back. You're literally missing out on probably some of the best data in co-living, the most straightforward, served up to you data in co-living, and you're just making it harder on yourself. So even if you don't leverage pad split to manage your properties, which I have my properties managed on pad split and I have properties not managed on pad split. I do both, right? However, I'm always looking at pad split to make sure these are great markets with a lot of good data, right? Do they have more demand than they have units by a multiple? 3, 4, 5 times as many people looking as there are units. What are people typically getting for shared bathrooms, private bathrooms? What is the average occupancy, first days, first booking, 80% occupancy? And then how are the zip codes that I'm looking at? How are those performing? Okay, so this one, 107 active units, basically all the rooms filled up. This one right next to it, this one's not as good, maybe because it's a little more remote. I know there's a university right here, so it just depends on where they're at. So it's important to also have a rep at pad split because they can share some of this more detailed stuff, street by street stuff with you. You can look all around and see which ones tend to do better. Is it the ones closer to the water? So there's not a ton here, but they're fully booked out. All these units are fully booked out. Does it do better? Sometimes you got to finagle with it. I don't know. You got to zoom in, zoom out. These ones tend to rent for higher amounts, although it's only 10. And they tend to book up pretty quickly and they're pretty full, but it's just a small sample size. So you can get a lot of great data from here. So with all that being said, let's work on our market. Let's work on this property. So we're going to go back here. We're going to go with this property. This is 3-bed, 2-bath, 1,708 square feet. So it's not huge, unfortunately. So let's go back to the property info. 2-bath, 1,708. Subject to, perfect. So you see how you have the mortgage balance plus the entry fee is pretty close, if not 100% accurate with what the purchase price is. That makes sense. That's how it should be if it's a straight subject to deal. Otherwise, there's some equity, right, that needs to be accounted for. Either you need to pay that up front, which then should be part of the entry cost, or it's seller financed, whether there are payments or not, like it's seller finance, there's still that equity that you owe to the seller at some point. That's the difference between subject to and hybrid, right? There's some equity remaining between the purchase price and the mortgage balance that is not getting paid out up front. Let's then go to this property. So it's straight subject to, right? We selected it's a straight subject to deal. It blacks out and completely eliminates anything that's has to do with seller finance or any new debts or anything like that. This is just subject to. So for this property, it is a $304,043 purchase price. The entry fee, so either you can have as a percentage or hard code it, right, is $33,499. And that's saying the loan balance should be $270,544, right? Your purchase price minus your entry cost, right? Which we're just lumping in as total because we don't know how this entry cost is broken down. We don't know how much is going to the agent, how much is going to the seller, how much is going to the wholesaler. But either way, you are going to provide that and it'll get distributed afterwards. You just need to make sure to account for that entry, and I'll show you how. Your purchase price minus your down payment should equal what the loan amount is you're taking over, and that is what we see here, right? Same exact value here is here. Great. If there's a discrepancy, you need to understand why. Let's say this was $50,000. This would leave this at $254, but that doesn't make sense because that's, right? You want to make sure that these numbers make sense. So for the entry cost, let's go back and quickly, before we figure out the loan payment and all that, what we're going to do is, because we're accounting for this entry fee, which is going to be a combination of cash to seller, arrears, agent commissions, wholesaler assignment fee, you need to make sure to zero out everything else here, which is the case. The arrears are 0, the agent commission is 0, and the wholesaler assignment fee is 0 right now. That's good. That makes sense because we're accounting for that in this entry fee. You don't want it to account for both. Maybe this all does not go to the seller, but it's going towards your entry cost into the deal that then gets distributed separately. It does not matter where it's all going. As long as you account for that, you don't double account for that, or you don't not account for that. You need to just account for that total amount. That is what all you need for your analysis. All right, so then let's go to the loan payments. So the loan payment, you have to recreate the loan payment. You're buying this property and you're taking over someone's existing loan. That means you're taking over responsibility of the payments for that loan. The principal and interest that they're paying on the loan, you need to account for that. You can only account for that by recreating the original loan, right? You have to recreate the original loan to understand this. This one says $2576.89. For the sake of analysis, right, this is your principal and interest for the loan, the subject to loan, and the taxes and insurance that are paid as part of the mortgage, right? It's all 4 of those combined. We can either recreate the loan and then account for these, or we can just hard code this amount right here, right now. We can just hard code this for the sake of analysis, or we can actually recreate the loan, by going to the original sub 2 loan term section here. So let's do that. Let's go on PropStream. Okay, we got the address. Usually if it's like a little off, you just need to go back a space or two. Oh, it could be lane. So it's got to like match up perfectly, unfortunately. Let's see if it's LN. Oh, 145. I forgot. There it is. So let's go in here. I will keep the original sub 2 loan right here, front and center for you. So if we go to click on the property, click details, it's gonna be hard to see. We're cramming a lot on here on one screen. I can't do it on my big screen, otherwise you guys cannot see it, but 2 loans on this one. So there's an FHA, maybe down payment assistance or something, or maybe it was pushed back. We need to get clarity on that. Talk to the wholesaler, you say, hey, I need clarity on this. Why are there 2 loans? Because this 15,000 is not accounted for. So where is this accounted for? Is this part of the entry cost, or like, is this gonna have to get paid off? We don't know any of that. What I think is this was some type of modification added onto the back of the loan. Maybe it's due at the balloon or a sale. So you need to get clarification because that was not listed. That was not listed anywhere here. So estimated loan payment. So we see the loan amount originally was $279,837. This was the original loan amount. So we're gonna put right here $279,837. Oops, I put that under interest rate. $279,837. The interest rate, it says 5.51, but this is estimated. PropStream doesn't know that for a fact. But that's why it's good to have these deals from wholesalers, because you know specifically they've verified this through a mortgage statement that it's 4.75%. The one deficiency that is not provided by PropStream, or the thing that they don't have access to, right? You need that directly from the seller. We have that now, right? So we can recreate this. The original loan term was 30 years, so 360 months. So 12 months in a year times 30 years is 360 months, so just 30 years. And the loan due date is August 31st, 2052. So basically that means the loan was pulled out 30 years prior to that. So August 31st, 2022, or the real payment starts at the first of the month. So September 1st, 2022 was essentially when this loan started, or that's a pretty good, we're not gonna be too far off. And that doesn't change the monthly payment, just changes for the loan amortization, like your payments, how much is going towards principal, how much is going towards interest. That doesn't necessarily matter for the sake of this piece of analysis. So this 1459.76 is how much is going towards the principal and interest of the loan. But we know the PITI, the principal, interest, taxes, and insurance is 2576.89 as it was provided from us. What I do know is because this is an FHA loan, part of that is going towards property mortgage insurance, part of that is going towards taxes, part of that is going towards interest. What we don't know is how does that broken down right now. So we just need to know what this difference is. We'll just call that. So that difference is 1117.13. So you're paying $1459.76 on the loan, and you're paying towards taxes, insurance, and mortgage insurance, PMI, 1117.13. We need to account for that in under the fixed expenses. Even if it's not 100% right, we need to account for that. So we need to make sure that these 3 values equal this, even though it might be wrong, right? We just need to make sure that the right payments are there. And then we will actually make sure it's the right taxes and insurance. So we can estimate. So right now we have $350, right? We're way off. You can assume around $200 a month for PMI. Just an estimate is going to depend on the loan amount. There's a simple equation. I don't know it right now. Doesn't really matter because as long as this 3 equal 11, 17, 13, we're good to go. You can estimate 150, we'll say, for insurance. Oh, whoops. So this, you see it's purple, so you put it in, or like this pink. You put the values in where the pink is, because then this is just coded from that. So we'll go 1,800, which is $150 a month. So that means the property taxes amount that's remaining should be equals 117 minus 150 minus 250 is 767.13 a month, right? So we can set here equals, it's actually, honestly, a lot of it probably goes towards insurance as well, because we can actually see what their taxes are. So if you go here, tax information, they paid almost $4,000 last year. So we can set this to 4,000. And actually we'll just back into they're paying a lot for insurance, a lot. 683. So I subtract away this one, 587. So something's off here. Maybe the PMI is much higher. Maybe they are making payments on that other one. It's included in here. I don't know. I honestly don't know. Maybe it is included in that payment. You need to get this information from the wholesaler. But we just need to understand that our monthly payment is accounted for here, right? The total monthly payment should be right. This value at the bottom, 2143, should be this 2576.89. Right? This is way wrong, right? Our taxes, something's off here. It's fine. We'll figure that out later. I think it actually is that second loan we saw. They're probably making payments on it. It probably isn't a balloon, they're probably actually making payments on that, which is contributing a couple $100s a month in addition to all this. I don't know until I get a mortgage statement. That's the next step with the wholesaler. So with all that being said, we have at this point the foundation of our entry costs. We know this is how much money we're paying at closing to the seller, agent, wholesaler combined. We're estimating our closing costs, right? Just 2%. Our transaction coordination costs, LLC formation costs, inspection costs around $3,400. This is just minor cleaning. Every property is going to need a little bit of minor touch up and cleaning. And then just a couple months of reserves, which depends on the management strategy. These payments plus whatever else. It's your first couple months of payments plus utilities and all that good stuff, so that you have that. And we have our debt information. So with all that being said, let's do co-living. And if we have time, we'll do long-term rental analysis as well. So let's see how many bedrooms we can add. We're only going to know that by looking at the photos. You got to look for like common areas. So you walk in. Actually, the best thing to do is let's take this address and just put it on the internet. Oh, so they're also trying to actively sell it traditionally. And look at that. They do have a floor plan. So you have an office. That's a bedroom. Nice. You have this entry that could be a bedroom right here. 1, 2. But yeah, you could definitely put a bedroom right there. I mean, there's a fireplace and all that, but that's okay. This is the office they're using as a bedroom, I think. Wait a minute. On their floor plan, do they have 3 actual? 1, 2. They already count this office as a bedroom. So they're already accounting for that as a bedroom. So you can maybe at most add 1 to 2 bedrooms. You have to figure out entryway for this one. Maybe that's what this door is. They have private entry. So you need a lot more info, but for the sake of analysis, let's continue on. I'm trying to have you guys understand my logic to help you out. That screen and patio is just a patio, just outdoor space. These are nice big rooms, so that's good. This is that office actually, but they're already counting for it as a bathroom. Very weird. So the gym is an outdoor gym. I don't understand. Missing most of its walls. So this probably would not be a great co-living property. It's going to be too small. So maybe at most, you're going to have this bedroom. These are both private. Oh no, this is a shared bathroom. That's good. And this is a private bathroom. This one's shared. You'll have the office, maybe the living room, maybe the gym, but there's going to cost you more money to get this one set up right. Because I think this was a garage conversion or something. I think the gym is this, which is pretty weird and disingenuous, but it's got HVAC. So maybe, maybe it's not a huge conversion, but you would still need to put money in to convert it. So at the most, this is honestly a 3-bedroom property that we can maybe turn into a 5-bedroom. For me, I like at least 6 bedrooms or more, but for the sake of analysis, let's go through it. So there's currently 3 bedrooms. We're going to add 2 more. The cost to build is just an estimate, $6,500 on average. It's like convert a living room into a bedroom. Basically put up a few non-load bearing walls. That's basically it. Ideally, you're doing multiple. If you're just doing one, it's going to cost more. If you're doing multiple at one time, you could pretty much get away with that. It's going to depend on your market. The contract you use is going to depend on a lot of things. For me, it's around this cost when I'm doing multiple rooms, typically 3+ rooms in a property. This might be even more because this gym is a little bit more. You can go here and just add another $5K because you got to do the flooring in there. You got a lot to do in that one. Furnishing costs, so $7,500. That's fine. So you're basically saying the total number of bedrooms. So the 2 that you're adding plus the other 3 that you have times $1,500 a room is $7,500 for furnishing. That's going to include furnishings for the bedrooms, right? Which is around $1,000 plus the excess for each room is going to go towards the common area. So the kitchen, maybe outdoor space, whatever you're going to do in the common areas. So with that being said, let's go to our pad split data. And for this area, we have 181 shared bathroom, 261 private bathroom. So as we saw, there's actually, the gym could also share that bathroom. So these are 2 shared and these are 3 shared. You can make this one just a private bathroom, but I wouldn't because a 4-bedroom to 1 bathroom is the max ratio you want sharing. So if you had this one share this 1 bathroom between these, you'd have a lot of people sharing one, where it might be better to actually just have everyone share the 2 bathrooms. Pretty much these 2 share this one, these 3 share this one, especially because it's bigger. That would make the most sense and provide the most convenience and enjoyability for your tenants so that they're not constantly turning over and moving out. So we're going to stick with, there's going to be 0 private bathrooms. So it doesn't matter what the rent is here. Does not matter. And the shared is going to be 5. The weekly rate for a shared bathroom is $181. So this weekly rate here doesn't mean anything. This could just be 0 because the only thing that matters here is the shared bathroom, because this is just zeroed out anyway. So you could set this 0. It makes no difference. It makes no difference at all. It's just 0. So in your fixed expenses, so insurance is going to cost you more as a co-living rental than it would as a long-term rental, or especially more than it would as the regular homeowners insurance people have, right? So any rental property is going to cost you more insurance than owner-occupied home. And a long-term rental is going to be cheaper than a co-living rent by the room property. It's just more stable. So at least an extra $100 a month being accounted for additional insurance costs. You're going to have your water and sewer 200, gas and electric 100, garbage 50, internet, Wi-Fi 100, landscaping 50, house cleaning 100. So basically $100 every quarter, every 6 months, however you want to do it. We can set this, since it's a smaller property, we can just have everyone take care of their own area. You can set that to 0 if you choose to. This is all up to you. And then whatever other supplies you're going to provide, on average, I put $50 for that. This is ultimately up to you and your market, and the cost for things in that market is here. You have to account for that. These are just numbers put in there. That's why they're pink. You're supposed to replace these with values that make the market. So then if you're going to leverage the PadSplit platform, we're going to pay them on average 12% fee to use their platform. So 12% of your income is getting paid towards PadSplit. That basically, PadSplit is to co-living that Airbnb is to short-term rentals. Essentially, they're not actually managing your properties, but they're helping provide guests to your properties, right? Like short-term rental or Airbnb, right? They provide guests to your property. They collect the income. You communicate on that platform to the guests and the tenants. That's what PadSplit does. And they charge a fee for that, which is 8% of the monthly income, but they also keep 100% of the first 10 days of income for a new tenant. That translates to around a 12% PadSplit management fee when you calculate it from a monthly basis. I include more info for that here. The other property management, so if you have another property manager that's doing it, and in addition to whatever PadSplit doesn't do, like you're doing the back end, they're actually moving the people in and all that, you want to account for those costs. Or if you're self-managing it, do you want to be paid for that or not? It depends. You can set that to 0. It's up to you. Vacancy. So we saw 92% occupancy, which 100 minus 92 is 8, right? Your vacancy is 8%. And your maintenance and capex, you're setting aside 6% of your total rental income for maintenance and capital expenditures. So you see here that your income is around 39.22 and your expenses are 45.43. This property is going to lose money every single month. It does not matter what you do. Like, it doesn't matter how you renegotiate the deal or whatever, because it's subject to deal. You cannot take away the payments. Like, the payment is what the payment is on that. And you can't just provide less coverage of utilities or anything like that, right? You can't fabricate the rental income estimate. You just can't do that. So when we look at it automatically, so you get your entry cost, your income, and your expenses, right? A lot of this is automatically done just through some percentages. You can see here broken down. Your income is 39.22. Your expenses are 33.27. The debt payments that we talked about, the PITI that we're talking about here, plus any utility costs, any additional insurance. Then we have our property management costs right here. It's the combination of these two, and our reserves right here. It's basically saying once you account for your income minus expenses, minus management, minus reserves, you're losing $621 a month. Well, my goal is to make $1,000 a month on a property, right? So your cash on cash return, how hard is your money working for you? Is this a good deal or not? You can't even calculate that. It's going to be negative because you're losing money. Whatever amount of money you put in, even if it's $1, you're losing money every month after that point. Why would you invest that money? It makes no sense. You're putting in money to buy an asset that then loses you money. Yes, you have ownership benefits, right? You will have ownership benefits like debt pay down and appreciation and some tax benefits. But for the majority of people, if you want to be financially free, you need cash flow. You do not become financially free through these wealth generating benefits, equity and tax benefits. You become financially free through cash flow. So you need to generate significant amount of cash flow to then replace your active income so that you no longer have to work for money outside of your real estate business. So with that being said, your cash on cash return is determining how hard is your money working for you. Well, in this deal, your total entry, the cost to build the rooms, furnish them, plus the entry cost listed here, right? The reserves, the down payment, the down payment that you're paying at closing costs, all that in total is, so you paid almost $80,000 to then lose $621 a month. Not a good deal. For fun, let's see if there would be another bedroom you could add and what that would look like. If you were able to add one more bedroom, right? So it says adjust rooms because you need this to equal the number of existing rooms plus new bedrooms. You need to be the same amount. So if we did do that, what would happen here? So you're paying more, right? You were paying around $80,000 before. Now you're paying almost $87,500, but you're generating also more income than you were before, but it's still not going to be. Because not only are you making more income, but you also have more because you're paying your management fees, your vacancy and maintenance capex are a percentage of your income. This also went up. So basically now you're very close to cash flow neutral. You're losing $80 a month. So even though your entry cost went up, because you're making more money, your cash flow is closer to positive. It's still not positive. And your cash on cash return is better. Even though you're paying more money to get into it, it's better because your cash flow is a little higher. Although in theory, it's still not zero. So this property is too small. Like there's just no way there's nothing we could do. Like maybe you convert this garage into 2 rooms because 2 small-ish rooms 11 by 19. You can make this 8 by 10 rooms. Illogical. That's too small. The minimum bedroom size you can have for pad split is 8 by 10. That's 80 square feet. That's already very small. You don't want to just compromise on that. Maybe this living room, but this living room accounts for this entryway and all these things. Like there's no logical way to make this property make sense. But I just want you to see the way that you analyze it and gather this income and kind of some of the things you can do. You can't fake and add rooms, right? But just to see, because this is a subject to deal, you're taking over someone's loan payment, you cannot change what their loan payment is. The most expense you have each month, which is your fixed expense, is the monthly PITI, principal and interest on the loan, taxes and insurance. Plus, in this instance, because it's an FHA loan, you have property mortgage insurance as well, because they put less 20 to 25% down payment, right? Because they use the lower down payment option. Sometimes that makes sense. I have a property that I bought with a 4-unit. I pay over $200 a month in PMI, but it generates me over $1,000 a month in cash flow as a small 4-unit property. It's awesome. It crushes. And it made sense to do that. And I got into it for a very low down payment. One of the first things I talked about in this video. But that's why I want to highlight, subject to, you can't do a lot. Seller financing is nice because you could at least try to renegotiate. If this was a hybrid deal and there was some equity left over, some seller finance equity left over, you can adjust the seller finance to say, oh, is it 3%? Do we defer payments? Like, what is it? With subject to, you can't do anything. It is what it is. The payment is what it is. All you can do is see, does it make sense with any management strategy? And that's going to account for, you're going to need to improve your property. If it's a long-term rental, it's a long-term rental, right? There's not a lot more you're going to have to add to it outside of just acquiring the property, maybe renovating a little bit. Co-living, you're going to have to renovate, add rooms, furnish. Midterm rental, you're probably going to have to renovate it. You're going to have to furnish it. And then there may be other entry costs. Short-term, same concept. Maybe even more renovations to make it even better, even more furnishings to make it even better. It's a different demographic. It's someone who wants to stay there for vacation. You have to provide them more amenities than you would a midterm rental. And you're trying to see, in any of these scenarios, does the income minus all the expenses, the cash flow, justify the amount into the deal? In this instance, I don't want to do the analysis on all these, but they provide you some income. We already know that our fixed expenses are $25.77. That counts for no other expenses, just the PITI. And what they have quickly here is, well, we know at co-living income of $47.06, it's still not enough. With their $2,100 long-term rental, well, we're paying $25.77, well, you're going to lose money as a long-term rental. It doesn't matter what your entry costs, you're still losing money. As a midterm rental, $2,400, you're still going to lose. It's still more than the fixed expense. Even short-term rental, $27.50, maybe you're positive in theory, as we saw here in the co-living. Even at $4,700 a month, you were negative because, first of all, if it's a furnished rental, well, you have to account for the utilities as well, and that very quickly eats into it. Then you have your management fees. Then you have your vacancy and maintenance and capex. Well, that quickly eats into that. There's no scenario in which this property makes any good financial sense as a buy and hold rental. You could make the case that maybe you can buy this and sell it to someone else who wants to live in it as a wrap or as a lease option. That's up to you. I think the payment's too high, the entry's too high as a percentage of the property value, and the interest rate's fine. It's under 5. And that's not my main thing. I want to buy and hold my assets, not buy and then sell them to other people. It's not worth my time personally. But that is the one case you make for this property. This is the majority of deals that you analyze are going to be this. They're not going to make sense. There's no renegotiation, there's no anything. That's good. You're doing your job. You are analyzing a deal and identifying it does not make sense. It does not make sense for you. It's not a good deal. Well, I don't know about the specific percentage, but like, let's say 80+% of the properties you look at will not be good deals to buy. 20% or less will actually be good deals to buy. Your job is to then filter and see what are those good deals. Sometimes, depending on the acquisition strategy, if it's seller finance, you might be able to renegotiate the deal terms, right? Here it says 3% interest. Well, maybe you can renegotiate that and it's 2% interest, and now it makes sense. Or it's a hybrid like this one. This one's nice. I don't know, we got to see where it's at, but there's a subject to loan. You can't change that. The PITI is the PITI, but maybe this 3% interest rate, you can drop that off. And if that's what makes the deal work, you just balloon them this amount in the future. So it just depends, or you pay them in installments, or whatever the case is, you figure out something, or you give them more in the purchase price, whatever it is. So those are things you can actually renegotiate. With straight subject to deals, it's hard. You can't really change. You can't lower that PITI. It is what it is. And in this instance, this property makes no sense with no management strategy as a buy and hold rental. So you move on, which is the majority of deals that you look at. I've looked at, for every deal that I buy, I look at dozens, right? And for the portfolio of 60+ rentals, I've looked at hundreds, if not over 1,000. Well, I've personally looked over 1,000 deals, but a big part of that was analysis paralysis. I was finding deals that made sense. I wasn't comfortable yet pulling the trigger and executing on those properties, right? Or sometimes I'm looking at these deals and then bird dogging them, getting them to another buyer because maybe it makes sense, but it doesn't make sense for me at that time. Maybe I have too many projects going on, or it's a market that I want to buy in. It makes sense to put it in someone else's for them to analyze. So with all that being said, hopefully this was useful for anyone that wants the calculator.